question about money and how will it cause inflation. I don't know. And I would say these two deflationary forces are pretty powerful in the short term. They're going to cause a lot of confusion. And you've heard me use the word velocity before. I know it's somewhat esoteric. All it means is the rate at which money turns over. If there's a lot of confusion, especially in the traditional world order, the velocity of money will continue to fall. The reason that the monetary easing globally during the 2008 and 2009 meltdown and afterwards, the reason it never ignited inflation was this velocity. The money went up, but the rate at which it turned over per year in the economy slowed down as people held back. They were risk averse, concerned about their futures, concerned about their company's futures. I think that probably will continue as these dueling deflationary forces, good and bad, duel with not duel with one another, actually are on the right side or the same side and against all of the monetary ease. So those are some of our thoughts. There are a couple others that, or one other, I guess, that I'd like to mention. It's focused, or the questions around liquidity in the ETF space broadly. Now, we manage assets in many different wrappers. And so I'm able to compare and contrast here. I think there's a misunderstanding of liquidity when it comes to ETFs. And I think the best illustration of how liquid and beneficial ETFs are in almost any situation is going back to 2008-09. Bond strategies during 2008 and 9, there were active bond strategies in the ETF wrapper. And there were a lot of investors very fearful and just wanted to get their money out of bond funds. And the only liquidity provider out there during that time were the market makers and authorized participants in the ETF space who made markets. Now, the underlying bonds were not trading. Bond traders were not picking up their phones or answering on their Bloombergs, DMing anyone. The markets weren't working. But ETFs were out there and provided a market, even though the underlying markets were not working. Did they take a discount for that? Yes, they did, and they should have. That was the price for liquidity at that time. Now, what's so surprising to me in this market, because this idea of liquidity in the equity ETF market has arisen, with the benefit of that experience, I would have expected those in the ETF world to understand that in the equity world, it would happen the same way. But the equity world is much more liquid generally than the bond market. And so when we were getting questions around this topic, I was surprised to learn that one of the most expert journalists and consultants in this space at Morningstar was basically feeding into the fears of the market, which surprised me, because I can tell you just from what we saw, there were, even though the markets were very volatile and the number of shares traded exploded, the volumes exploded, the ETF industry and the ETF infrastructure handled it beautifully. And as a portfolio manager, I know the difference between an ETF wrapper and a mutual fund wrapper. A portfolio manager in the ETF space does not have to worry about flows. It's the market makers, the authorized participants. It is, the ETF ecosystem that is accommodating the activity. So I'm just making investment decisions. That's all I have to make. In the mutual fund world, it is not always the same, as many in 08, 09 learned. When there are redemptions, a portfolio manager does have to worry about those if the market has shut down. Normally, that's not the case. 08, 09 was a very special case. But a portfolio manager does have to deal with the flows and the investment decisions. So I hope this serves as some kind of comfort, explanation for what's going on out there. I've been surprised, as I said, at some of the ETF commentators. They should know better, but they haven't managed money, so maybe that's not fair. But I am managing money, and I can tell you the difference between the two wrappers is quite significant.